Warren Buffett's 5 investing tips for people who don't follow the stock market. 1. An investment strategy that the Oracle of Omaha would approve of. You don't need to spend countless hours scourging financial statements and reading stock reports. Warren Buffett has a pretty simple strategy that he thinks is the best way for the overwhelming majority of people to invest. Number 1. Buy S&P 500 index funds. While Buffett is without a doubt the world's most famous stock picker, he doesn't think most people should invest in individual stocks for years. He's embraced S&P 500 index funds as the best way for most Americans to build wealth. By investing in an S&P 500 fund, you become an automatic investor in all 500 largest companies whose stock the index tracks, including Berkshire Hathaway, Amazon, Apple, Facebook, Google, and so on. Buffett has left instructions in his will stating that 90% of his personal wealth should be invested in the S&P 500 index funds. The remaining 10% will be placed in short-term U.S. Treasuries. Although Buffett is a long-time proponent of index investing, for most people Berkshire Hathaway only recently added 2 S&P 500 funds to its portfolio. In February, its 13F filing revealed that it had purchased shares of the Vanguard S&P 500 ETF and Spider ETF, though combined the funds still make up less than 1% of Berkshire Hathaway's holdings. Let's take a moment and see what Warren Buffett himself has to say about invest in index fund. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over a long period of time. But I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times occasionally. I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time. As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price-earnings ratio determines things. I don't think price-book ratios, price-sales ratios. I don't think any. There's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks, or not to buy stocks, or anything of this sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You can't. You'd love to have something that said, if P's are 12 or below, or some number, you're buying. If they're 25 or above yourself, it doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it. So if you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions. But do you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact? And I would, if you're a young person and you intend to save a portion of your income over time, I just say pick out a very broad index. And I would probably use the S&P 500, because I think, if you start getting beyond that, you starting to think you should be in small caps this time and large caps that time, or this foreign side. And as soon as you do that, you're in a game. You don't know you're not equipped to play in all candor. That would be my recommendation. 100 years ago, one share of S&P 500 was trading at less than $10. You can also call it points, since it's an index fund, but for simplicity we'll stick with dollars. Now one share costs nearly $3,500. So if you would have invested 100 years ago, and withstood all the fluctuations and volatility, you would have generated 350 times your money today. Not bad at all. Not doing any financial research and still becoming wealthy. On average, S&P 500 generates 10% annual compound rate. As Albert Einstein once said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Number 2, keep the fees low. Most fund managers who try to outperform a broad index like the S&P 500 will underperform in the long run, as Buffett frequently points out. That's why he loves to slam fund managers who charge high investment fees. In spite of a not-so-stellar track record, Buffett famously bet $1 million that an S&P 500 index could beat 5 hedge funds over 10 years. Of course he won the bet and donated the winnings to charity 1 year earlier. He predicted his win in 2016 letter to Berkshire Hathaway shareholders, and fund manager fees were a major factor. Quote, "When trillions of dollars are managed by Wall Streeters charging high fees, it'll usually be the managers who reap outsized profits, not the clients," Buffett wrote. So, when you invest in S&P 500 index funds, look for the one with the lowest expense ratio possible. The lower the expense ratio, the more of your money actually goes into the investment. For example, if you invested $1,000 in a fund with a 0.1% expense ratio, $999 of your money would be invested, and the remaining $1 goes toward fees. In case you were wondering, the Vanguard and Spider ETF that Berkshire Hathaway owns have an expense ratios of 0.03 and 0.09% respectively. Number 3. Pay off credit cards before you invest. At Berkshire Hathaway's 2020 shareholder meeting held virtually in May, Buffett was asked about the state of the credit card industry. He used the occasion to remind the world of the high cost of carrying a credit card balance. Even though Berkshire Hathaway often profits from credit cards given its heavy financial sector holdings, Buffett told the story of a friend who sought his advice about what to do with her money. He asked her if she had credit card debt. She did, with an April of 18. Buffett told her that the interest savings from paying off the credit card debt would be far greater than she could earn from any investment. Quote, "I don't know how to make 18, he said. At last, if you want to invest like Warren Buffett, you don't need to do anything extraordinary. In fact, many new investors are surprised at just how uncomplicated the Oracle of Omaha's investment style is." To sum it up in one sentence, Buffett invests in great businesses trading for less than their intrinsic values, and then he holds on to these investments for as long as they remain great businesses. Warren Buffett doesn't invest in junk. You typically won't see him buying struggling businesses, regardless of how cheap they become. One of the best Buffett quotes new investors can absorb is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Let me know what you guys think about investing in index fund. Leave your thoughts in the comment section below, hit that like button and subscribe.